let's talk about a crime that happened right out in the open. A heist that involved the biggest banks in the world. And you know what? It quietly affected millions of us. It was even called the crime of the century, but most people never even knew it was going on.
I mean, just think about this for a second. What if the interest rate on your mortgage, or your student loan, or your credit card, what if that number wasn't set by some fair market force, but was actually being secretly manipulated by a small group of traders in a chat room?
Because, well, that's pretty much exactly what happened. The system they were rigging is called Libor, the London Interbank Offered Rate, and it was the foundation for over $350 trillion in financial products all around the world. No, that's not a typo. Trillion, with a T.
And look, this wasn't some abstract number that only mattered on Wall Street. It was directly wired into the everyday finances of regular people everywhere. If you had any kind of adjustable rate loan between, say, 2005 and 2012, this scandal probably hit your wallet.
So first up, we're going to break down how this massive heist was pulled off, right under everyone's noses.
To do that, we have to look at the system that made it all possible. To really get the crime, you first have to understand Libor, which was once known as the world's most important number.
To put it simply, Libor was supposed to be a measure of trust. It was the benchmark rate for how much it cost the world's biggest banks to borrow money from each other. So if Libor was low, it meant the banks were feeling healthy and confident. If it was high, it was a big red flag that there was trouble.
Okay, and here's the fatal flaw. The rate wasn't based on actual, real transactions. Nope. Instead, a group of giant banks would just estimate what it would cost them to borrow money that day, and then they'd submit that number. The final Libor rate was just a simple average of what they all said. It was a system built entirely on the honor system. I mean, what could possibly go wrong?
Right, so now let's pull back the curtain and see how that system of trust was completely and totally shattered. We're going inside the trader chat rooms.
The manipulation basically happened in two ways. First, during the 2008 financial crisis, banks started lowballing. They'd submit fake low rates to pretend they were healthier than they really were, trying to avoid a panic. But at the very same time, something even more brazen was going on. Individual traders at different banks were just messaging each other, colluding to nudge the rate a tiny bit up or down to make their own multi-million-dollar trades profitable.
Now, the way they got caught is just incredible. The entire conspiracy was documented by the guys committing the crime. All the evidence was just sitting there, hiding in plain sight, in their chat logs on the Bloomberg terminals that every finance pro uses.
And this just shows you how ridiculously casual it all was. Traders would literally ask their buddies at other banks to submit a high or low rate, and they get a simple reply back like this one. There was no code, no secrecy, just a straightforward agreement to rig the most important number in the world. And the rewards for these little favors? They weren't hidden either. It was all right there in the chats. Promises of expensive champagne. This wasn't some sophisticated, shadowy plot. For them, it was just a routine part of the job, and they talked about it as casually as making plans for drinks after work.
So, obviously, when this all came to light, the fallout was huge. Let's dig into the consequences, the eye-watering fines, and the one and only person who actually went to jail for it.
All told, the banks involved, we're talking the biggest names in finance, paid over $9 billion in fines. It's a massive number for sure, but for institutions of that size, a lot of critics just saw it as the cost of doing business.
And the penalties hit banks all over the globe. Barclays, UBS, Deutsche Bank, they were all in on it, which really shows you just how systemic and widespread this whole thing had become.
So the banks paid fines, but only one person ever saw the inside of a prison cell for rigging Libor, a trader named Tom Hayes. He was a brilliant numbers guy, and prosecutors painted him as the evil genius, the ringmaster of this whole global conspiracy. He was sentenced to 11 years.
But Hayes has always said he wasn't the ringmaster. He was just a scapegoat. His defense? He was just doing what he was told. He argues that rigging Libor wasn't the work of a few rogue traders. It was an institutional practice, something everybody knew about and was even encouraged by the bosses. And that really is the central question of the whole scandal.
I mean, this whole thing played out over more than a decade. The first hints of trouble started back in the 2008 crisis. The scandal really exploded in 2012. Hayes went to prison in 2015. And it wasn't until 2023 that the broken Libor system was finally officially put out of its misery.
Which brings us to our final section. Now that the dust has settled and all the fines have been paid, we're left with a much bigger question. Was justice actually served here? So the Libor name is gone. It's been replaced by a new benchmark that's based on actual data. But just changing the system doesn't make the huge fundamental questions this scandal brought up just disappear. The Libor scandal proved that any system built on trust alone, on banks just promising to report their own data honestly, is just waiting to be corrupted. It showed us that when billions of dollars are on the line, an honor system is really no system at all. It makes you wonder, can we ever really trust a financial benchmark that isn't based on cold, hard, verifiable data?
And what about accountability? The Tom Hayes case leaves you with a really uncomfortable question. How is it that a mid-level employee goes to prison, while the senior executives who create the high-pressure culture that encourages this kind of behavior get to walk away, keeping their jobs and their massive bonuses?
And that leads to maybe the most unsettling question of all. This wasn't some tiny hidden fraud. This was a conspiracy to rig the world's most important number, and it went on for years. How on earth did the regulators, the watchdogs whose entire job is to prevent this stuff, miss it for so long? That's the one that should keep all of us thinking.